the last video, we covered the balance sheet and the income statement, the two documents that tell you whether a business is actually healthy. Near the end of that video, we hit two things that I promised to discuss more about. The first being the number we landed at the very bottom of the income statement, the net income of $229,100. Does that number mean that the restaurant actually has that much money sitting somewhere? You'll think so, but it actually doesn't. Depreciation showed up as expense on the income statement. It reduced our net income, but no cash actually left the building when it was recorded. The cash left years earlier, the day we bought the equipment. That's the reason why net income and cash flow aren't the same thing. A company can look profitable on paper, reporting a strong net income, and still be very low on actual cash. And a company can also report almost no profit and be sitting on plenty of it. The other thing is the taxable income we applied a rate of 21% to and moved on with. We never really explained where the number actually came from, or a rule about it that is easy to get wrong. So today, using the same Scalify Hatchmal and Tang example, we're going to be covering two things. First, corporate taxes, because the formula we're about to build a cash flow for needs that tax figure as input. Then we'll build the cash flow to answer the real question of today's video. Where does the money actually go? Let's get into it. Most people think a company just pays one flat percentage on everything it earns. That used to be true, and it used to not be true, depending on which rate you're actually talking about. And understanding the difference actually matters. So here are two different tax rates you will need to know. There is your average tax rate, which is your total tax bill divided by your total taxable income. This is the overall percentage that ends up going to the government. Second, we have the marginal tax rate. This is the rate you pay on the next dollar you earn. Those two numbers are not actually the same thing, and mixing them up leads to real decisions being made on bad information. So let's actually see why they're different. For years before 2017, the corporate tax code didn't just use one flat rate. It used tier brackets, meaning the first chunk of a company's income got taxed at a lower rate, and each chunk after that got taxed a little bit higher, all the way up. Let's run our own restaurant's number through that old system. Remember how Scalify Hatchmal Tang had $290,000 in taxable income last year. Under the real pre-2017 schedule, the first $50,000 was taxed at 15%. The next $25,000, which is from $50,000 to $75,000, is taxed at 25%. Similarly, the next $25,000 from $75,000 to $100,000 is taxed at 34%. And everything from $100,000 to $335,000 was taxed at 39%. In our restaurant's case, that is only $190,000. That huge jump from 50% to 39% is kind of like a bubble bracket that existed specifically to call back the benefit of the lower brackets from bigger companies. So working through those rates with our restaurant's numbers, using the figure from the left, we can add up four pieces together. There is $7,500 plus $6,000, $250, plus $8,500, plus $74,100 gives us a total tax bill of $96,000, $350. Now here's the two rates we talked about before. Our average tax rate is $96,000, $350 divided by $290,000, about 33.2%. Our marginal tax rate is 39%, the rate on the very last dollar we earned. Notice how these are two completely different numbers, and here's why. The average rate is blending together everything we earn, including the first $50,000 that only got taxed at 15%. The marginal rate ignores all of that. It only cares about the rate sitting on the last bracket we touched. That's why marginal will almost always sit above average in a system like this. The average is being dragged down by every cheaper dollar that came before it. And here's why that distinction actually matters. If Scalify Hatchmal Tang is deciding whether to take on one more catering contract that adds taxable income, the marginal rate is what tells you the real cost of saying yes, not the average. The average rate just tells you about your overall bill. The marginal rate tells you what the next dollar actually costs you. But here's actually a twist. As of a law in 2017, the Tax Cuts and Jobs Act, the corporate tax rate isn't tiered like that anymore for most companies. It's just a flat 21% no matter how much taxable income you earn. So let's rerun our restaurant's number through today's rule. $290,000 times 21% is $60,900. That's exactly the tax figure from our income statement last episode. Same business, same income. But under today's rule, Galify Hatch pays $60,900 instead of the $96,350. That's over $35,000 saved just from a change in the law. And notice something else here. With one flat rate and no brackets to climb, average and marginal tax rate became the same exact number. If Scalify Hatch earns $1 more tomorrow, that dollar is taxed at 21%, same as every other dollar earned. No more gap between the two rates. So if they're the same number now, why do we just spend so much time separating them? Because they're still answering two different questions, even when the answer happens to match. Average tax rate tells you what percentage of total income got paid in tax. Marginal tax rate tells you what happens to the next dollar. And that's the one financial decisions actually gets built on. When we get to things like the value of a tax shield on interest later in this series, it's the marginal rate doing the work, not the average. For a simple flat rate company like ours, they clap into one number. But they won't always stay that way. State tax, credits, deductions can pull them apart again. And marginal is still the rate you reach for when you're deciding what to do next. So here's what I meant before. That 21% is a statutory rate, what the law states on paper. In practice, deductions and credits mean that the rate a company actually ends up paying often looks different from a statutory number. This is what we call an effective tax rate. It varies company to company and industry to industry. One more thing worth knowing is that the 21% is a federal rate only. Add in state and local taxes, and a company's real total tax can end up higher than the 21%, depending on where it operates. That's not a loophole story, and it's not us implying anything shady is going on. It's just the difference between the rate printed in the law and the rate a business actually pays once every legal deduction and credit and every level of government is applied. Moving on, one consequence of a high corporate tax rate is that some companies restructure entirely to get around it. We call this a tax inversion. A company merges with a foreign one and shifts its legal home base overseas, so its earnings outside that country aren't taxed at the higher domestic rate anymore. Here's the connection back to what we just covered. Before 2017, the US corporate tax rate topped out well above 21%, among the highest in the developed world. That's exactly the environment that made emergence attractive in the first place. Part of the reason why the rate got cut to the flat 21% was to remove that incentive to make staying put simply cheaper than restructuring to leave. It's still controversial. Critics call it tax dodging. The companies doing it call it staying competitive. Either way, it tells you something worth remembering. Taxes aren't just a line item at the bottom of a spreadsheet. They shape real corporate decisions, including where a company chooses to legally exist. So why do we need to go through all of that before getting to cash flow? Because of the exact tension I raised at the beginning of the video. Depreciation lowers your taxable income and your reported profit, but the cash already left the building the day you brought the equipment. It's not leaving again. Taxes are the opposite. That money owed is actually gone, right now, the year it's owed. Of everything sitting in the income statement, taxes are the one of the only lines that both an accounting expense and a real cash outflow at the same time. Which means that if you want to track real cash movement, not just the accounting story, taxes have to be part of the formula, calculated correctly. And so now we can begin talking about cash flow. Remember the question from the beginning of this video. Net income was $229,100. Does the restaurant actually have that much cash sitting around? Net income includes non-cash stuff like depreciation that never touched the bank account. And it leaves out real cash spending like buying new equipment that absolutely did. Cash flow fixes both of these problems at once. It's the closest thing to an honest answer to how much actual cash did this business generate and where did it go. This is the importance of cash flow and why we need to understand it. So we are going to be talking about the cash flow identity. Here's the big idea underneath everything we're about to build. All the cash a company's assets generate has to go somewhere, either to the people who lend the company money or to the people who own it. Nothing just sits there in limbo. So here's the formula. Cash flow from assets equals cash flow to creditors plus cash flow to stockholders. That's the whole logic. Every other formula in the rest of this video is really just building out one side of that equation, piece by piece. So let's begin by building the left side first. Cash flow from assets include three main things. The first is operating cash flow. Operating cash flow is cash generated purely from running the business, before anything about how it's financed or how it's growing gets factored in. The formula for it is Operating cash flow equals earnings before interest and taxes plus depreciation minus taxes. Notice what's not in the formula: interest. Interest is what it costs to finance the business, a decision about how the restaurant is funded, not about how it actually operates day to day. Same reason it sat below EBIT on the income statement last episode. If we include it here, it will lead us to mixing an operating number with a financing one. Taxes, on the other hand, do belong, because unlike interest, taxes are a cost of doing business no matter how it's financed. And unlike depreciation, they're paid in real cash. Now looking at the middle term, depreciation, this is the actual fix for the tension we opened this video with. Depreciation reduced net income on the income statement, but it never cost the business $1 in the moment it was recorded. The cash left years earlier. So to get back to real cash, we add it back. We are literally undoing the accounting adjustment that made net income disagree with the cash in the first place. Now let's use our restaurant's real numbers from last episode. EBIT was $310,000, depreciation was $10,000. Taxes under today's flat rate was $60,900. Now we add the depreciation back, subtract the taxes. This leaves us with $259,100 in operating cash flow. Notice that it is a different number from the net income. Net income was $229,100. Operating cash flow is $259,100, $30,000 more, almost exactly the depreciation plus the difference in how much interest gets treated. It's the non-cash items paragraph from last episode, now solved with an actual number. The second part of cash flow from assets is net capital spending. Growing businesses spend real cash on real things: new equipment, more space, new machinery. That's capital spending. And here's how it's actually calculated. Net capital spending equals the change in fixed assets plus that year's depreciation. We add depreciation back for the same reason we did a moment ago with operating cash flow. It reduced the fixed asset balance on paper, but it isn't new spending. So we separate that out from the real dollars going toward new equipment. So here's where our restaurant story gets bigger. This year, Scalify Hatch Malatang opened a second location. Fixed assets on balance sheet went from $180,000 at the start of the year to $380,000 by the end. New kitchen equipment, build out, everything a second Scalify Hatch Malatang used to open its doors. That's a change of $200,000. Add back this year's $10,000 in depreciation, and net capital spending comes out to be $210,000. Growth costs real cash right now, not later. And here's also something worth knowing. This number doesn't always come out positive. If a company sells off more fixed assets than it buys, let's say closing a location instead of opening one, the change in fixed assets goes negative, and net capital spending can come out negative too. It's not one directional, it just happens so to be a big growth-driven number this year. Finally, the last thing is related to a concept from last video, a change in net working capital. Growing also ties up the cash in the day-to-day stuff. More inventory sitting around for 2 kitchens instead of 1. More money owed by customers and catering clients that hasn't come in yet. Remember net working capital from last episode, current assets minus current liabilities, which came out to be $25,000. With a second location opening, that number grows. Say it ends the year at $44,100. That's a change in net working capital of $19,100. Cash that is now tied up running 2 restaurants instead of 1, not sitting free in the bank. If a company is growing, this number is almost always positive. That's not a bad sign by itself. It just means cash is being absorbed into the business, not freed up. Now let's put the whole left side of the identity together. Cash flow from assets equals operating cash flow minus net capital spending minus the change in net working capital. So that is $259,100 minus $210,000 minus $19,100, and that leaves us with $30,000. This is often called a free cash flow, the cash that's truly left over after running the business and reinvesting in it. Notice how small that final number looks next to $259,100 in operating cash flow. That's the whole story of this year for Scalify Hatch Malatang. Almost everything the businesses generated in cash got poured straight back into opening the second location. That's not a warning sign. That's what growth actually looks like on paper. Now where did that $30,000 actually go? That brings us to cash flow to creditors, now the other side of the equation. Also, creditors are the people who lent the company money. So the formula for cash flow to creditors equals interest paid minus net new borrowing. Interest paid this year was $20,000, same figure from our income statement. But to help us fund that second location, Galify Hatch Maotang also took out $40,000 in new borrowing. So $20,000 minus $40,000 leaves us with negative $20,000. Notice how that's negative. That doesn't mean something went wrong. It means more cash flowed in from creditors in the form of that new loan, then flowed out to them in interest. When a company borrows more money than it pays in interest, this number goes negative. And that's completely normal in a growth year. Finally, the last part of the equation is the owners. That is the cash flow to stockholders. And the formula for it is cash flow to stockholders equals dividends paid minus net new equity raised. Remember from last episode, net income of $229,100 was split into $179,100 kept as retained earnings and $50,000 paid out as dividends. And for our restaurant this year, no new equity was raised. So $50,000 minus zero leaves us with $50,000 in cash flow to stockholders. So now we are finally closing the loop, and let's watch how this all actually tie together. So we have negative $20,000 to creditors plus $50,000 to stockholders, which equals $30,000. That's exactly the free cash flow number we landed on a while ago. Every dollar the business generated this year is accounted for. Some came in from creditors to help fund the expansion, some went out to shareholders as dividends, and what was left over funded the second location. Nothing just disappears. The identity always holds true, no matter how the cash actually moved. And that concludes today's video. We close the gap between what a business reports and what it actually has in the bank. We started off with taxes, going back to something we glossed over last episode, the difference between what an average tax rate and a marginal tax rate is, and why that distinction still matters now even though the two collapse into the same number under today's flat rate. We worked through how the old pre-2017 bracket system actually taxed a company compared to today's flat 21% rate. We also touched on why the statutory rate on paper isn't always what a company actually pays, when state and local taxes and deductions come into play. And we cover why some companies relocate entirely through tax inversions to escape a higher rate. From there, we made the turn into cash flow, establishing why taxes are a genuine cash outflow in a way depreciation never was. We set up the real question of the episode. Why cash flow, not net income? Is the actual scoreboard for whether a business has money. We built the cash flow identity, every dollar of the cash a business generates going either to creditors or to stockholders, then built it piece by piece, starting with operating cash flow, deliberately excluding interest since that's a financing decision rather than an operating one. We then have net capital spending, tracking real cash spent growing the business. And then there is a change in net working capital, tracking cash quietly tied up in day-to-day growth. Putting those together gave us the cash flow from assets, or free cash flow, which we then split into what went into creditors and what went into stockholders. Closing the loop by showing that those two pieces add back to exactly the free cash flow number, proving that nothing just disappears. And that's it for today's video. Thank you so much for watching. I'll see you in the next.